I've been trading pure price action for the past 10 years. I've been using no tools, no indicators, just purely candlesticks. There's a lot of information out there, so in this video, I'm just condensing that 10 years of knowledge into what I believe is the most relevant part to build a 2 and a 3R strategy for you to implement into your own trading, whether you are completely new to trading price action or you are intermediate level. And I would consider an intermediate level price action trader as someone who understands the concepts from my first video, which is trend continuation, and then being able to identify key levels to trade from and being able to trade reversals, which is what I'm going to discuss in this video. And the good thing about price action trading is that it works on any market and it works on any time frame. So whatever you're trading, this is going to be relevant to you. So let's just get into it. The pattern is this, essentially. It's really simple. What we're looking for is a trend to the downside, some sideways price action, and then a breakout in the opposite direction to the original trend. It looks like this in candlestick form. Obviously, it's a little bit easier to see it in just lines, but this is what it looks like in a real life example. And this is a very textbook example of it. Where we can see the range has been defined, we've got two lows. We have two higher lows in this instance, which is indicative of a reversal in trend. We have two higher highs, all getting signals from the market that price wants to push up. And then the breakout is where we're looking to trade, we're looking to enter on this. And just like women, these things come in all shapes and sizes, but they're all beautiful, except maybe the liberals. So just to give you a couple of examples of how this may look, because the textbook example is really clean and obvious. Sometimes they're not as clean and obvious, but once you're trained, you'll be able to see this. And I'm just marking the breakout on here, the breakout entry, which is what we'd look for. But you can see that there are a couple of lows, a higher low, high, 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 and then on this high, high, we look to enter. And then on this instance, we have a lot more sideways price action. We have a way bigger range than the previous examples. But again, we have signals from the market. We have a high high here. We have a higher low. We have a high high in the context of this overall range, more higher lows. And then on this breakout of the range, this is where we look to enter, and then price is free to trend away. In the previous video, this was the pattern which we were using. We were looking for a trend to the upside. We were looking for a range to go sideways. We'd wait for the price action to form, and then we would trade the breakout. Very simply, we're just going to flip that trend. So what we're looking at is a downtrend into support. We have the step 2, which is to define our range. Step 3 is waiting for the price action to tell us what it's going to do. And this is in a series of higher lows and higher highs, and then we look to step 4 to trade the breakout. And then just for the sake of adding shorts into the argument as well, we're going to focus on longs, but this will be covered more at the end of the video. Exactly the same type of thing, just the inverse. We're looking for a trend up, sideways price action, and then a breakout to the downside. So this is how it looks more in a real life example, just so it's not obviously as clean as a textbook example to train your eye, because it would be lovely if you open the charts and it all looks really clean like the line example. But we have a couple of lower highs, and then we have a couple of lows, lower lows, and then we have the breakout to the downside. And this is where we would look to enter basically. So the thing is, we want to trade these patterns at particular points in the chart. We want to trade them where there's going to be liquidity, and we don't really want to just trade them in midair, in the middle of a trend or whatever, because there is a greater chance of failure at those points. So I'd look to trade at decision points. A decision point is where there is the origin of selling or buying that engulfed a key support or resistance level. If the engulfed key support or resistance level is itself a decision point, it adds even more weight to your directional bias. And we look to take trades around these levels due to their likelihood of producing a strong reaction. And this is where we can expect the most liquidity. I know that's a lot to kind of digest. You've probably got no idea what that means. This is completely useless without pictures. So let's dive into it, and then we'll break it down, and then you'll understand it a little bit more clearly. So ultra grade professional line charts again. Here we have a high that has been put in on this chart, and then essentially price has moved up, gone sideways, and then pushed up again. And let's mark it. This is our decision point. This is where the decision was made to break the high, and we can also call this an origin level, i.e. where the origin of buying took place to break the high. So if we just take it back to this point, this is where you'll see things forming when you're watching the charts live. So I just want to talk about the concept of supply and demand trading and the logic behind these decision point levels and why we look to trade them and why they're so key. So for example, let's say it takes $5 million to break this high. That's the cost to break that previous high. However, someone has put in $10 million of orders at this level, and with just a cost of $5 million to come and break the high, that would leave $5 million at this level in resting orders. So if someone had a $10 million position, for example, $5 million of that has been filled and then price has moved up. Sometimes that can happen very violently and leaves unfilled orders. So that would be $5 million of unfilled orders at this level. When price returns to it, we can expect a bounce. We can expect that $5 million of unfilled orders to be filled and then push price back in the direction of the original trend. Sometimes when price moves up, doesn't test the level again, and then forms another bit of sideways price action before eventually dropping down and breaking that decision point, we have another decision point. This is a bearish decision point. This is a decision point that breaks another decision point, and this is a very key level. So if we just go back to our maths, if there was $5 million of orders unfilled at this level, for example, there may have been $10 million of selling to come down and break that level, which means that on a retest of it, we want to look to go short and ride the wave of unfilled orders that will be filled. So if we just go back to the original slide where we're talking about decision points, just to see if it makes a little bit more sense now. So decision points are the origin of selling or buying that engulfed a key support or resistance level. In this case, it was a high. It was a very obvious high on the chart, and that should be quite clear for you. If the engulfed support or resistance level is itself a decision point, it adds even more weight to your directional bias. And again, like I said, we look to go short at this level. This is a key level because it's broken another key level. The thing with supply and demand trading is that you can mark any box, any sideways price action as a demand or supply zone, but this is basically what I would define as a key level because it's where decisions were made to break previous highs and lows on the chart. So if we look at some candlestick examples, because again, the line chart is really nice, but you're not trading line charts, are you? On this picture, there are several of them. Maybe you want to pause and see if you can find them, but probably not at this point. So I will just go ahead and mark a few that I've seen on here, and then we can go from there. Example 1, so we have an obvious high here and another obvious couple of highs here. We have a cluster of buying which pushed up to take out these highs, and then on a retest of this level, we can see that prices pushed up. Example 2, again, we've got some clear highs. We have a little cluster just before the break of these highs, pushes up, price comes down, and then reacts from that decision point. Example 3, again, similar thing, but actually in this instance, we have a chain. So we have, this is a resistance level, a decision point, which has broken a decision point. And then here we can see 1 retest, 2 retests of it, and strong reactions. Example 4, again, we have the decision point, the bearish one here, to come and take out this zone. And then on a retrace to it, 1, 2, 3, we can see those different examples of price reacting from it. But just to give you the textbook example, the clearest example that I could find on the charts, we have a high here, and then we have a decision point here, which has come and broken the high. And then on a retest of this level is where we would look to trade. It's kind of simple when you look at it like this, and it will add a different element to your supply and demand trading. But for me, this is basically where we want to read key information from the charts, where we know there's going to be strength in this level because it has taken X amount of buying to come out and take a resistance level out. So let's put it all together. Here we have a nice looking chart, and we want to know how we can get involved in this big move to the upside. So if we just take it back a little bit and then we just define our range with the breakout candle, that should give you a little bit more of an idea of where we'd look to enter. But again, let's just take it a step back and build it all up so you understand. Remember, this is our pattern. We're looking for step one, a trend into support. Then we're going to define our range. We're going to wait for some price action. We're going to wait for the chart to tell us that it wants to reverse. And then on the breakout on step 4, we're going to enter our trade. So step 1, we're looking at trending into support. We have a local bearish trend or a retrace because we have a bit of an uptrend. We can see these highs have been taken out. So now we're just coming into support. So let me just mark that. And we have our resistance. We have our high. It's just a clear high that I've put in. And it sometimes doesn't need to be any more complicated than that. It is just something you can eyeball. And then at the break of this high, we find our decision point, our origin of buying to engulf the resistance. And now price has come down to test it. So I'll just remove that just so we don't have too much on the charts. And now we just need to define our range. And here it is. So we have our trend low, and then we have a retrace high, and then we have a test of that low. So at the retrace point, once that retrace point gets tested, again, we can define our range. We have enough price action at this point to tell us that we have a range. And this is exactly the same type of thing we were looking at in the beginner video. However, what could happen is price just decides to continue without us, but we've given it enough time and we've given it enough of a chance to build. In this instance, it doesn't. Sometimes it may just bounce and say, fuck you, and go without us, and that's something we can deal with. But my edge lies in waiting for the price action to build and giving us a little bit more information about what the market wants to do next. We want to try and improve our strike rate as much as possible, and waiting for this price action, although it may not come as often, when it does come, it will give us more of a chance of winning. So we can see here, we have multiple tests of the range high and we have multiple tests of the range low, which means that price is at an indecision point. So a decision now will be made when we get a breakout to the upside or the downside. Since we're at a decision point, a demand zone, which we previously marked, we're looking for a reversal, we're looking for a breakout to the upside like this. So this is now our trade. The way I would trade this is entering a market with a stop below the low of the range. And then as you can see here, we see a nice move to the upside. And with these reversals, I would look to take profit at 2.5 to 3R. You normally can catch quite big trends on them if you've got them quite low in the overall context of the chart, as you can see in this overall window. So that's quite nice. Or you can, if we just take it back a couple of notches, you can take the first breakout as a signal that the market wants to go up. And then you may want to put a limit order on the range, and you can get a little bit tighter with the risk reward at this point. And then price comes down, tests the level, and then pushes us to the upside. However, we are in an intermediate video, and if you've watched the beginner video, which I would recommend if you haven't, we can put two concepts together at the same time here. So for example, we have our information that price has gone sideways, it's broken to the upside, and now we know that from what the market is telling us, it wants to move up. We just need to get another entry. So we have another range stacked on top of this range. If we wait for the price action to go sideways and then break out again, we have another entry. this is just a continuation pattern. This is a confirmation that the low has been put in from the sideways price action at the range, and then we can see it pushes up. A little bit less of a risk reward compared to the actual low, but it still works, and you'd go for 2R as per the continuation rules in the first video. Or again, you can take a signal from the market and then look to trade with a limit order and then catch it. So this is 2 examples of how you can trade at these points. Obviously, you're not going to get them all the time, but this is a really clear textbook example. And if I just add the decision points in there, you can see what a beautiful picture this is. We have the trend down into the support, we have the price action moving sideways, and we have the breakout, and we can catch this trend either on the breakout trade, or we can take a limit order on the retest of this range, and then we may even get a continuation at this point. So we have a couple of entry triggers for this and a couple of different ways to trade it. At this point, you may be thinking, well, if these decision points are such great levels and you understand the logic of them and you understand that they provide bounces, and you may have seen these many times before yourself, or you may go away and decide to have a look and do a little bit of research on these levels and see that they work a lot. You can trade them with limit orders first time if you like. You could, for example, put an order down like this. The reason I don't like doing this, and this is how I have come to trading with the strategy which I'm showing you in this video, is because of things like this. Price comes down, bounces initially, but then just drops through it. Sometimes, and this one hurts, it will come down, bounce, and then catch you out with a couple of pips, and then bounce and then go without you, which really stings. So I like to just wait for the instances where price moves sideways at these key levels, and then gives me the information that it's going to break up to the upside, and then trade at market once the range high has been broken with some strength. And then you could also, as I said before, take a limit order on this and trade it that way as well. Setting limit orders on those levels is great for higher time frames and if you aren't able to be active in the charts. But for me as a day trader, I like to wait for the price action to develop, get involved at the right time, and suffer as few losses as possible. And I found the best way to do that is simply just waiting for more price action at these levels. Sometimes you will be waiting more for one of these patterns to actually evolve and paint on the chart for you to trade, but when they do, you can be way more confident that they're going to give you a winning trade. So we've covered longs, and I'm just going to give a couple of short examples as well, because you need to train your eye to see both directions, but the concept is exactly the same. If we just bring it back a little bit, so we have the decision point, which we were talking about before, and the resistance point, which was where the decision was made to push above. And now we have a bearish decision point, the origin of selling to engulf the support. And remember, it's a key support because it's a decision point. So what we're looking for is a retrace to that decision point, the bearish one, to go short from. Sometimes it may just move sideways like this and continue to the downside, in which case we can use our strategy from the beginner video to look for a continuation. But in the event that it moves back up, what the pattern we're going to look for is a trend into resistance at step 1. Remember, when we were looking for longs, we were looking for a trend into support. Step 2, we're going to define our range, and we're going to define our range in the same way that we did in previous videos. We look for the trend, we look for the retrace high, and we look for the retrace low, and that retrace low is confirmed when that retrace high is tested again. And then we're just going to wait for some sideways price action, and then we're going to wait for the breakout on step 4 to enter. Or if you're going to use a limit order, use it as a signal to enter with a limit order on a retest. So let's bring it back to the chart. We get our step 1 trade into resistance, and then we define our range at step 2, and we can see the trend high, the retrace low, and then the test of the high, just to define our range. And then we have our breakout, which we can enter short from, or as I said before, we can look to enter a limit order using that as a signal of intent from the market, and then use the range as our place to enter on the limit. Your job now is basically to identify what are key levels and what aren't key levels, what are the key decision points on the charts and which ones to actually trade. The best way to do this, as a little bit of homework for you, is to jump onto TradingView and use the box tool and just go back in time on any chart and mark out what you think are decision points and see what the reaction is to them. Then you can also start marking them live and then seeing by observing what happens to them. Also jumping on a back tester as well and getting a load of reps in. I think the more reps you get, the more you're going to build that understanding. And a back tester tool is a great way to just build those reps in such a short amount of time and just to ingrain that pattern in your brain essentially. If you've got any questions on anything that I've talked about in this video, leave a comment below and I will get back to your question. Absolutely. There is a free Discord link in the description as well. And soon I will get to part 3, the advanced section, where we're going to be looking at different time frames and how to trade the failure of these patterns when they don't work out. I hope you've enjoyed. If you have enjoyed and you found this valuable, give it a thumbs up and share with your friends and get your friends to share as well, okay? And your next video is somewhere around here. Cheers.